welcome back to our monthly video commentary series for the month of March. I'm Nik Schuurmans, partner and wealth advisor at Waverly Advisors. What a difference a month makes since we last saw you all. Up until the end of February, markets were humming along. Many of the themes that we've been talking about, the great rotation, value, small cap, emerging markets, international, all were doing quite well. And then a conflict broke out at the end of February. Much has flipped. Now it's all about oil, inflation, the Fed's path, global interest rates. Not to minimize the impact of conflict, but financial markets have really turned. And we're going to dive into that, looking at the current drawdown opportunities, the signal amongst the noise. We have some great graphs to share. And as always, the situation is fluid, so this is being filmed on March 31st. By the time you get this on Sunday, things might look a little different, but this is a pretty good summary of where we're at and future opportunities that could lie ahead. So let's get into the slides. Per usual, we like to get into asset classes that matter to our clients and intra-month movements. And as the heading of the slide indicates, there was really nowhere to hide unless you were jumping in and out of oil or energy stocks. Cash was a decent place to be as well, but for most corners of the market, there was really nowhere to hide. So starting at the bottom up, gold, which is a asset class that we like long-term here in green, really was hit hard. There's all sorts of narratives on why that was. Some say that many of the Gulf states have been net buyers of gold over the past couple of years, and they needed liquidity, so they were mass sellers of gold once the conflict broke out. Next is emerging markets. So this is really a oil-dependent block of countries. So many of their supplies have been disrupted on the energy side, sold off rather aggressively. International and emerging markets tend to be very cyclical, meaning tied to economic output, tied to supply chains. So pre-war, those were doing quite well. In post-war, those have sold off fairly aggressively. That's EEM and EFA. EEM is emerging markets, EFA is international developed. Real estate, very rate sensitive. So again, another consequence of the war was energy up, bond yields up, dollar stronger. A lot of the Fed rate cuts that were priced in heading into 2026, investors have backed off that expectation and now modestly pricing in hikes, even though I don't know if that'll stick. But this is not just a U.S. story, it's a global story. Rates across the world, bond yields across the world have ticked higher. Of course, real estate is rate sensitive, interest rates up, real estate down. That's another area that we really liked before the war broke out. NASDAQ, we'll get into some of the Mag 7 movement. I think a lot of people feel worse about the current sell-off because Mag 7 AI technology was probably the most crowded trade that we've seen in some time. And as we'll get to a future slide, a lot of those companies have sold off rather aggressively, much worse than the overall indexes. The S&P 500 down about 7% in the month of March. Bitcoin's actually held in there pretty good. Bitcoin's had a rough start to the year, but for some reason, again, Bitcoin can move without rhyme or reason. Bitcoin is held in there quite nicely. And then government bonds, 7 to 10 year, SCHO, that's short-term treasuries. While negative, those have done well to mitigate some of the downside risk in equity. So all in all, a pretty ugly month. There's nowhere to hide. A lot of these asset classes that were beaten down really sold off aggressively, namely international and emerging markets. But when you zoom out long-term, I think if you're sitting on cash, if you're looking to get a little more aggressive in your asset allocation, this is probably a decent opportunity to nibble at some of those other equity asset classes. Pivoting to AI Mag 7, a drawdown from 52-week high. Not to say we told you so, but this is a theme that we've been talking about for a while, the last 12 to 18 months, really, where many prospective client portfolios that we saw were massively over allocated to big tech. It's probably the most common concentration that we've seen, certainly the biggest concentration that I've seen in my 20 plus year career And this is the other side of concentration, where most folks are happy to be concentrated in taking risk when the Mag 7 trade is doing well, when the AI is doing well, but this is the other side of it. Not to belabor the point, but for most of our clients that are retired or about to retire, taking concentrated bets in any asset class is probably not a wise move. When you're retired, you want to tighten the range of outcomes. You want to mitigate drawdowns, which translates into, hey, yeah, sure, we want to own the Mag 7. We want to own AI. We just want to be very mindful of our exposures and position sizing. So for those folks that had a concentration, it's probably a little less concentrated given these ugly, crooked numbers down. But it's never too late to go back to the drawing board, to be honest with yourself, to be honest about your capacity to take risk, and really focus on the risk management side. Because as I've said in the past, most folks are very in tune to how they're doing. I'm up 10% on the year. I'm down 10% on the year. Almost nobody can tell you how much risk that they're taking. And we just want to get in front of that before it's too late. Now, the flip side of that is, again, if you have cash or you're looking to enter a Mag 7 position, the tech sector, from a PE standpoint, meaning how expensive or cheap it is trading now at parity with the S&P 500. And that hasn't happened for a long, long time. When you look at this chart going back to 2020 or 2019 even, where tech stocks in the S&P 500 were trading at a similar next 12-month PE, which essentially means that investors are valuing the next 12 months of earnings for the S&P and tech companies around the same level. So again, if you're a long-term investor sitting on cash looking for a position in the Mag 7, if you don't have one, it's certainly more compelling than it was a few months ago. So this is a chart that might encourage those folks that are looking to get exposure. This is a better entry point than it was, again, even 3 to 4 months ago. In a previous blog, we've written about the three-headed monster. Well, what is the three-headed monster? It's energy prices, U.S. Treasury bond yields, and the U.S. dollar. When those three important metrics are moving up together, that's a headwind for stocks. And many folks are trying to market time or guess what happens next. So goes energy, so goes the U.S. dollar, so goes bond yields. That usually is a pretty good predictor or precursor to how U.S. equity markets are moving. And it's no surprise when you get this massive jump over the past month in oil, in bond yields, and the dollar that equities are going to be challenged. So, I would caution those folks that just say, hey, we can rotate into sectors that tend to do well during a conflict like this. Well, things can change on a tweet. Headlines can be very fickle, and markets are forward-looking, so it'll sniff out if things are starting to change, or if the president does send out a tweet, things can back up rather quickly. It's okay for a short-term trader or short-term investor to jump in and out of energy, although we wouldn't recommend it. That's a good way to end up on the wrong side. But for long-term investors, you don't want to get outside of yourself. If you have an asset allocation that works, that's balanced, that you're comfortable with, it's probably not a good idea to start jumping in and out of certain sectors based on what other traders are doing. But if you're looking for a signal, this is a really good signal as far as the current environment goes to explain some of the equity price movements. We touched briefly on rate hikes, which were rate cuts about a month ago. So you can see this chart, and this is not just a U.S. dynamic. This is spread across the world, where you can see the dark blue bars marked February 27th were the number of hikes or cuts that were being priced in prior to the war. And you can see most of these dark blue bars, especially for the UK and US and Canada, were biased towards cuts. So anything below this zero bound was basically pricing in cuts. And how this would read is, prior to the war, investors were pricing in about 2 cuts for the US market. Same thing for the UK. This lighter blue is what investors are pricing in now. And this, of course, is post-war. This is as of March 25th. Now the US is basically neutral investors are not pricing in cuts nor hikes, even though this is slightly above the zero bound. This is basically pricing in the current rate is essentially neutral. But look around the globe. Bond yields have aggressively shifted higher. Most global markets are pricing in hikes. And that's due, again, to this more cyclical nature of foreign countries. They're heavily dependent on oil imports to keep their economy moving along. Well, if the price of an oil input spikes by 30 or 40%, that impacts inflation, impacts energy prices, prices at the pump, jet fuel, pretty much everything in a cyclical based economy. So this is something to watch. And of course, the U.S. is less dependent on foreign oil than it was 15 to 20 years ago. But still, investors, consumers are certainly feeling the pinch at the pump. And the longer this goes, the more likely the Fed could or investors could price in a rate hike in 2026, which was not on the radar before the war broke out. So this is something that's evolving. Know that investors in rate hikes in these rate markets are quite fickle. As you can see how quickly they change from the 27th of February to the 25th of March. If we get a change in rhetoric, if we get a de-escalation in the conflict, it wouldn't surprise me to see this return to what it was pre-war, meaning markets are pricing in rate cuts in the US and in the UK. But again, some of these markets are fickle and they're really sensitive to headlines right now. So I would take this with a grain of salt. One of our favorite indicators is sentiment. In other words, how investors are feeling about the current backdrop. Not a surprise, almost every investment survey out there is bearish or pessimist. So anything below this gray line, this zero bound, and these different color lines are just the various investment surveys. So these are usually taken once a month. They pull a subset of investors, and it gives us a summation of these surveys, which basically tell us, are investors optimistic? Are they pessimistic? And right now you can see most of these surveys, all of these surveys, are below the zero bound, which means there's more pessimistic investors than there are optimistic investors. And you might say, hey, Nick, that makes sense. This isn't anything earth-shattering. However, this is notoriously a contrarian indicator, meaning future returns are often best when investors feel the worst. Just let's look at a few recent data points. So back in 2022, if you recall, inflation higher, rates higher, the S&P sold off by 20%. A lot of these investment surveys were deeply bearish, and you can see what happened after they turned deeply bearish. 6 months later, 3 months later, markets took off. So if you overlaid the S&P 500 with this survey data, this would essentially mark the bottom, and the S&P went higher in 2023 and 2024. Same thing happened in 2025 during the tariff tantrum. Markets sold off by 20+% in about a month. Investor sentiment was in the dumps. This essentially marked the bottom here, and the bottom was somewhere around here. Markets screamed higher. I'm not saying this is going to happen again, but humans are notoriously poor at predicting inflection points. When people start talking about a global recession and stocks are going to fall another 30% and everyone's selling or panicking or making irrational emotional decisions, that's usually a decent time to start sniffing around. And you can see this has been the cycle bottom up to this point. I'm not saying that sentiment can't get worse, but again, this is an interesting setup for the contrarian investor that pays attention to sentiment. And in that same vein, so we just looked at sentiment, the VIX is another good one to look at. So when the VIX spikes, so the VIX has been called the measure of fear within financial markets. The higher the VIX goes, the more volatile stock prices are, and usually stocks are selling off when the VIX is rising. So this is essentially a look at future 6-month S&P 500 returns at various levels of the VIX. And currently, the VIX is right around 30. So it's kind of bumbled around 29 to 31. And we've highlighted what that means. So when the VIX rises above 30, that indicates fear in stock prices. And you can see we've highlighted that here. Current levels of the VIX are at this red circle in the bottom right of the graph. Future 6-month returns, once the VIX crests 30, once it goes over 30, are about 9.3% for the next 6 months. And this data goes back, I believe, 40 or 50 years. So again, when people are fearful, when folks are panicking, when they're emotional, when they're consuming mainstream media and mainstream news, that's usually a decent time for future stock returns. Okay? Most investors really do the opposite. When markets are humming along like 2023 and 2024, I have to back off investors that are really not risk-seeking, that are more balanced investors from getting more aggressive because they think, hey, stocks are up, it's less risky, I want to get more aggressive, I want to participate in this up market. That's usually the worst time to get more aggressive. And conversely, the best time to get more aggressive is when it feels the worst, when people are panicking. So again, this is not my opinion. This is based on empirical evidence. And we're big on finding the signal amongst the noise. If you want some pretty good metrics that have stood up against the test of time, look at sentiment, look at levels of the VIX and future returns. Again, I'm not saying this is going to hold every time, but this is a pretty good benchmark for making asset allocation decisions, for putting cash to work, for getting a little more aggressive. Switching gears to private credit or private debt. We haven't really dived into this because for our clients, for the legacy pure clients, we haven't invested in private debt or private credit, and that's intentional. I'm a firm believer that retirees, folks that are retired, need to have access to their money. And I'm not saying private debt doesn't have a place for some folks, but it's in a liquid asset class, meaning if you needed the money for whatever reason, many of these private debt funds have gates where you can't get all of your capital, or there's windows where you can access 5 to 10% of your capital. But this has been in the news lately, and just real quickly, I talked a bit about this on our podcast, but post-financial crisis, a lot of banks tightened their purse strings, meaning they were shy to lend money, especially to lower quality companies, to startup businesses. And that really sprouted a shadow banking system, if you will, where other lenders rose up, alternative lenders or non-traditional lenders rose up and started lending money out to startup software companies or riskier businesses or businesses that didn't have a track record of revenue but had a promising business plan. And that worked great for a period of 3 to 4 years when rates were low. There was a lot of good opportunities out there. It was an untapped asset class. But once the story got out that investors could earn 10, 11, 12% by loaning money to some of these riskier companies, a whole bunch of investor capital, institutional capital flowed into the private credit space. And what ended up happening was there was too much capital chasing too few good loan deals. And when you have too much capital chasing too few good loan deals, bad loans get made. And when rates go up, the economy slows down, there's a disruption like an AI comes along, you have the potential to see your capital wiped out or severely haircutted. And now it's kind of the Wild West where no one really knows what these loans are worth. A lot of these plan sponsors that you see on the screen haven't marked these loans to what they're actually worth. Many people don't know what they're worth. They can't sell them. Investors can't get their capital out. So again, I'm not saying that this is going to blow up. Certainly, this is much smaller than the subprime loan market. You know, some folks have compared the private debt potential crisis to what happened in 2008. I don't think it's that severe. It's not that big. However, there probably is going to be some stress in this area, and you can argue there currently is some stress in this area. Investors can't get their capital out. Some of these loans probably need to be marked down. So this is something to watch. Again, we don't have exposure to this area, but I know many institutional investors, many high net worth investors do. And again, it goes back to knowing what you own and knowing the potential range of outcomes. And I feel like anytime you invest in private markets, you're dealing with a lack of transparency, a lack of visibility. And I've always followed a rule. If you need a 100-page prospectus to explain what you own, that's probably not for me. And certainly for folks that are retired, again, they need access to their money. Many folks are living off their portfolios, and I just think it's a liquidity mismatch. So there you have it. It's been an ugly month, but again, as we've said in the past, a lot of these geopolitical events, unless you're a day trader, are really tough to trade for the long-term investor, which is why we pound the table on investors being really plugged into what they own. If you have multiple advisors, multiple accounts, sometimes it's tough to know exactly what you own. No, that's what we really excel at. We have several tools that can dissect a client portfolio, a prospective client portfolio, to really understand how every asset that someone owns moves in relation to each other. We can stress test. We can go back and look at 2008, 2022, the tariff tantrum, to understand how your portfolio acted. We can offer suggestions and opportunities to shore up drawdowns. So if you're uncomfortable about the current sell-off, know one, that this is well within the normal intra-year drawdown for the S&P 500. In fact, it's about half of what's normal for any given year. If you're uncomfortable at these levels, it's probably a sign that you're taking too much risk. So again, most investors are very plugged in and very aware of how they're doing from a performance standpoint. Most investors and advisors can't tell you how much risk that they're taking. So this is a great time to do that. Markets are still within shouting distance of all-time highs. This is a gift. This is a great opportunity to go back and kick the tires on risk. So if you have any questions on how we do that, shoot us a note at Oswego@waverlyadvisors.com. It's right on the screen. A 10-minute consultation could minimize your future regret if we do get a more meaningful correction. Thanks for watching. Thanks for tuning in, and we'll see you next month.